some investors' questions. Investors were forced to accept a different environment and a different way to invest after being used to loose monetary policy and lower rates. Thus, we decided to answer several questions we received from our clients in hopes that our views can shed some light on what we consider attractive opportunities for the year ahead, dependent on our macroeconomic views.
Since Latin America started hiking rates earlier than most developed countries, it should also be expected that its easing cycle will come earlier than the rest. But what about inflation? Isn't that one of the biggest worries for the region in 2023?
Since Latam started hiking rates earlier than most developed countries, it should also be expected that its easing cycle will come earlier than the rest. But what about inflation? Isn't that one of the biggest worries for the region in 2023? In most of the last monetary policy meetings of the region for 2022, practically all central banks highlighted the observed setback in inflation in its latest readings available. However, the monetary authorities stressed that inflation remained above target. Its expectations for 2023 were above target, and in some cases, the variable proved stickier than initially expected. The increase in inflation came mainly from higher food prices that most Latam countries faced due to the Russia-Ukraine conflict that began in February, which also caused a spike in gasoline prices across the region and made price pressures a constant throughout 2022. Going forward, and as we enter the new year, most market analysts have penciled in that the central banks that are still not done tightening will continue doing so during the first quarter of 2023 to bring their monetary policy further into restrictive territory. Nonetheless, the possibility of some central banks performing rate cuts in the second half of 2023 is not a far cry, as long as the monetary authorities see a positive evolution of both inflation and inflation expectations that across the region are currently unmoored. However, central banks should be conscious and cautious when performing rate cuts, since overdoing the easing process could pose additional risks for the monetary authorities in terms of potential inflationary challenges. The latter, considering that global interest rates will remain high during the year, and the global risk perception is still latent. Hence, a front-loaded monetary easing could leave the region exposed, given that most countries do not have enough fiscal policy space to stimulate if needed.
For 2023, most countries in Latin America expect a deceleration in their growth trend. Why should we focus on them amid our investment recommendations?
Deceleration in 2023 will be a reality, since the region is facing headwinds from waning real consumption and a higher rate environment unseen in Latam for quite some time. Most Latin American economies were already observing decelerations in their economic activity indicators in October, with some, like Chile's IMESEC, falling into negative territory. Nonetheless, this deceleration should be taken with a grain of salt. If inflation effectively recedes during the first half of 2023, with expectations anchoring, it would not be surprising to see some Latam central banks cutting rates in the second half of the year as an attempt to revive economic growth. However, as some analysts have pointed out, central banks should be cautious not to overdo their easing process, since they risk having too expansive monetary policy by cutting rates too soon without enough footing to keep inflation expectations anchored. A softer growth environment after the exceptional rates portrayed in 2021 may be a short-term price to pay to bring inflation back to target. In sum, pulling the trigger on implementing a looser monetary policy before its warrant could prove counterproductive for the expected post-pandemic recovery of the region. On another note, the Russia-Ukraine conflict disrupted the world and Latam's importance in the international trade. According to the IDB, the current backdrop presents an opportunity for the region to contribute to the global economy by contributing more actively to the global supply chain while benefiting from the nearshoring phenomenon that the US has been implementing. Hence, the IDB estimates that nearshoring could add an additional $78 billion in additional exports of goods and services in Latin America and the Caribbean in the near and medium term. The entity also forecasts that the countries that would see the most significant gains from nearshoring would be Mexico and Brazil, as can be seen in the following map. Thus, even if the initial outlook for growth looks grim, some factors bode well for a medium-term recovery in the region. If central banks are prudent in managing their monetary policy in a way that does not unmoor inflation expectations and allows economies to gain traction again, then Latam could benefit from the potential advantage that nearshoring could bring to the region in terms of foreign direct investment, or FDI. In that case, the path towards an economic recovery could continue in the second half of 2023, a strong contrast from the deceleration and even potential recession that analysts are penciling in for other regions in the world.
2021 and 2022 were years when the political sphere took center stage in Latin America. What can we expect for 2023, a year in which only one presidential election will occur?
As you stated in your question, we expect 2023 to be a calmer year in terms of elections, contrary to what we witnessed over the past 2 years. Nonetheless, the political picture is still muddy for some of the region's countries, which could dampen the investment outlook. The recently appointed governments of Chile and Colombia are still facing challenges when trying to implement their campaign promises. Brazil just had a new president sworn in at the beginning of this year, and the situation in Peru remains volatile. Even against this backdrop, the fact that the region is mostly transitioning from a newly appointed government to a consolidation state may put politics in a backseat, at least until October, when Argentinians will come to the polls to choose a new president. This change is visible in the risk perception across the region, with the 5-year CDS having tightened in the last quarter. However, a couple of points should be monitored in the political sphere. Let's analyze this. As we previously mentioned, the governments of Chile and Colombia will be starting their second year in power, and with it, additional challenges are coming their way. In the case of Chile, it remains to be seen how the Boric administration will handle the development of a new constitutional process after the failure of the constitutional referendum from last year. In mid-December, several political forces agreed to start a new constitutional process that will carry on between January and November of this year. It is worth highlighting that the second attempt at a new constitution should also be ratified or rejected through a plebiscite that will entail a mandatory vote for Chilean citizens. An expert commission will be installed in January. The election of a constitutional advisors will require a ballot and will take place in April. And in May, the installation of the Constitutional Council will take place. The proposed roadmap establishes that the draft of the new constitution will be delivered on October 21, to be voted on November 26 via a new plebiscite. The baseline of the new constitution exhibits several changes from the previous version. The new text now establishes Chile as a single, indivisible nation that recognizes all communities, while the Chilean state is seen as unitary and decentralized. In the case of Colombia, the government passed a watered-down tax reform aimed at financing part of the social spending that the Petro administration promised in his campaign. Furthermore, at the end of 2022, Finman Ocampo presented the 2023 financial plan update. He revealed the government's projections regarding the expected GDP and the fiscal deficit construction, which includes a 4 trillion pesos payment to finance the Oil Price Stabilization Fund, or FEPC as it is known by its Spanish acronym. Moreover, Ocampo highlighted the fiscal deficit reduction that is expected for 2022 and the government's commitment to fulfilling social needs through an increase in primary spending that is based on higher government revenue and on higher tax collections. Nonetheless, the fiscal outlook for the country still looks uncertain, with the government's fulfillment of the fiscal rule in the upcoming years being dependent on the non-inclusion of the payments to be performed to the FEPC, adding to the uncertainty related to the forecasted net debt to GDP decline. Fitch highlighted these worries when it affirmed Colombia's sovereign rating at BB+. The rating agency stated that one of the factors that could lead to a negative rating action or a rating downgrade could be the failure to achieve a fiscal consolidation that would eventually lead to a significant deterioration in the debt to GDP ratio relative to the BB peer median. Meanwhile, Petro's administration will also face the challenge of presenting and implementing reforms to the health and pension systems, which poses an additional governability challenge since this type of reforms usually pose tensions with the most traditional segments that are not part of the government's coalition. In the case of Brazil, the newly sworn-in President Lula started his government on January the 1st, after his victory sparked several protests from former President Jair Bolsonaro's supporters and disrupted the country's order. Even if Bolsonaro ultimately conceded and accepted the results, Brazil is still deeply polarized, and this could force Lula's hand into a higher spending strategy. Thus, it will fall on Lula's shoulders to outline the path for a sustained debt decline while building fiscal buffers. Meanwhile, it should be noted that the Brazilian Congress approved a constitutional amendment to maintain the Bolsa Família subsidy, even if this expense would happen outside the spending cap. This is worth stressing, since the specific subsidy should not impact the country's ability to fund its expenses in the near future. Nonetheless, investors expect Brazil's debt-to-GDP ratio to rise dramatically in the long term, which could undermine the country's ability to overcome potential external shocks. Some analysts even expect Lula to seek to extend his capacity to spend outside the cap in the late 2023 for the remainder of his presidential tenure. Lastly, Peru's political situation remains murky, even if the newly appointed president, Dina Boluarte, has made tremendous efforts to bring peace back to the country. After Congress impeached former President Castillo, she came to the role, which sparked protests across the country and has occasioned at least 25 deaths. In an additional attempt to bring the country together, Boluarte has announced her intention to move up elections for 2024 instead of completing Castillo's tenure that was supposed to go until 2026. Congress has already approved this project, bringing Boluarte's tenure to an end on July 28, 2024, and the Congress term ending 2 days before. Moreover, amid her attempts to surround herself with technocrats, Dina Boluarte performed a cabinet reshuffle in which she appointed the country's defense chief, Alberto Otállora, to the prime minister's job. Boluarte has also tried to exhibit a conciliatory tone in her statements, aiming at putting Peru first while avoiding any political revenge. Still, it remains to be seen whether Boluarte will be able to finish her already shortened period until 2024, while trying to bring Peru back to a more stable economic environment.
Insignia Financial Group, LLC, comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.